Hey, welcome to Personal Economics. Today, we're diving into a topic that's shaking up the US economy and could hit your wallet hard: the national debt, now over $34 trillion. Is this a ticking time bomb? And what can you do to protect your money? Stick around to the end because I'm sharing 3 practical strategies to safeguard your finances. If you want to keep your money safe, don't forget to hit like and subscribe for more content like this. Let's get started. How bad is the US debt? First, let's get real. $34 trillion is a mind-blowing number. To put it in perspective, if you stacked $1 bills to reach that amount, you could circle the earth multiple times. But what's really worrying isn't just the size of the debt, it's how fast it's growing. In 2024, the US debt ballooned by nearly $1 trillion every few months. Experts say it could hit 140% of GDP by 2035 if nothing changes. Why is it growing so much? A few reasons. First, the government keeps spending more than it takes in. In 2024, the fiscal deficit was over $1 trillion. Second, the interest on the debt is exploding. This year, the US will spend about $870 billion just on interest payments, more than on defense or education. And third, an aging population means higher costs for programs like Medicare and Social Security, which are politically untouchable. But here's the big question: why should you care? Because this debt isn't just a number on a screen. It impacts the entire economy, from inflation to the taxes you pay. When the government borrows more, the Federal Reserve sometimes raises interest rates to control it, which makes your loans, mortgage, even your credit card more expensive. And if the debt spirals out of control, we could see an economic crisis that hits everyone. What happens if this collapses? Picture this: the US keeps racking up debt, global investors lose faith in the dollar, and they start demanding higher interest rates to lend to the country. This is already happening to some extent. Countries like China and Japan, which hold huge amounts of treasury bonds, are starting to diversify their reserves. If confidence drops further, we could see the dollar lose value. What does that mean for you? Everything from gas to groceries gets pricier. Inflation is already high, with the consumer price index still a headache for many. Worse yet, if the government can't pay its debts, it might have to cut social programs or raise taxes drastically. That would hit the middle and working classes especially hard. And let's not forget the risk of a recession. Economists like Mark Zandi from Moody's warn that the debt could limit the government's ability to respond to an economic crisis, like the one in 2008. Bottom line, an out-of-control debt isn't just a government problem, it's a problem that ends up in your bank account. How to protect your money? Alright, let's get to the good stuff: how you can protect your money from the fallout of this massive US debt crisis. I'm going to walk you through 3 practical, actionable strategies to shield your finances, no matter how rough the economy gets. These aren't just theories, they're steps you can start taking today to stay ahead of the curve. Let's dive in. Strategy 1: diversify your investments like a pro. If the US debt keeps climbing and shakes confidence in the dollar, assets tied to the US economy, like stocks or bonds, could take a hit. To protect yourself, you need to diversify, and I mean really diversify. First, consider real assets that hold value when inflation spikes. Gold is a classic hedge; its price often rises when the dollar weakens. You can invest in physical gold, like coins or bars, or go for gold ETFs for easier access. Real estate is another solid option. Rental properties or rights can generate income and hold value over time. But don't stop at US borders. Look into international markets to spread your risk. Emerging economies, like those in Southeast Asia or Latin America, can offer growth opportunities. Index funds or ETFs tracking markets like India or Brazil can be a smart play, but do your homework. Some of these markets are volatile. For example, the MSCI Emerging Markets Index has shown strong long-term growth, but it's not immune to global shocks. If you're new to this, start small, maybe allocating 10 to 15% of your portfolio to international assets. And always check fees and risks before jumping in. Diversifying isn't just about protecting your money, it's about giving it room to grow, no matter what happens in the US. Strategy 2: shield your savings from inflation's bite. Inflation is like a termite eating away at your savings. With the US debt driving up prices, you need investments that keep up. Treasury inflation-protected securities, or TIPS, are a great starting point. These bonds adjust their principal based on the consumer price index, so your returns rise with inflation. For example, if you invest $1,000 in TIPS and inflation jumps 3%, your principal adjusts to $1,030, plus you earn interest. They're low risk since they're backed by the government, but keep in mind returns are modest. Another option is high-yield savings accounts or certificates of deposit, CDs. Right now, some online banks offer savings accounts with APYs around 4 to 5%, way better than the 0.5% you'd get from traditional banks. CDs can lock in rates for a year or more, which is great if you think rates might drop. For instance, a 1-year 400 at 4.5% can protect your cash while earning a decent return. But shop around, compare rates on sites like Bankrate or NerdWallet, and watch out for penalties if you need to access your money early. If you want to go bolder, consider I-bonds, which are also inflation adjusted and super safe. The key here is to make sure your savings aren't just sitting there losing value. Strategy 3. Crush high interest debt before it crushes you. If the debt crisis pushes interest rates higher, and it likely will, your credit card or personal loan payments could become a nightmare. Right now, the average credit card interest rate is hovering around 20%, and some are as high as 30%. Imagine paying that on a $5,000 balance. That's $1,000 a year just in interest. Prioritize wiping out any debt with rates above 10%. 2 proven methods can help: the snowball method, where you pay off your smallest debts first to build momentum, or the avalanche method, where you tackle the highest interest debts to save the most money. Let's say you have a $3,000 credit card balance at 18% and a $10,000 personal loan at 12%. With the avalanche method, you'd focus extra payments on the credit card while making minimum payments on the loan. If you can pay $500 a month, you could clear the credit card in about 7 months, saving hundreds in interest. Then roll that $500 into the loan payments. Apps like Undebt.it or Debt Payoff Planner can help you map this out. Paying off debt isn't just about saving money, it's about giving yourself breathing room if the economy tanks. Plus, being debt-free feels pretty darn good. The US debt is a serious problem, but you're not helpless. Start today by reviewing your budget. Where can you cut back to save more? Then, look into 1 or 2 investment options to protect against inflation. And most importantly, stay informed. The economy changes fast, and staying ahead can make all the difference. If you found this video helpful, give it a like and share it with someone who needs to hear this. In the comments, let me know, what are you doing to protect your money? Or what economic topic do you want me to cover next? Subscribe and hit the bell so you don't miss a thing. See you in the next video.